Ladies and gentlemen, good day and welcome to the IDFC First Q3 FY24 earnings call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chintan Shah from ICICI Securities Limited. Thank you, and over to you, sir.
Thank you, Darwin. Good evening, everyone, and welcome to the Q3 FY24 earnings conference call for IDFC First Bank. We have with us from the senior management, Mr. V. Vaidyanathan, Managing Director and CEO, along with the other members from the senior management team. So without further delay, I would now like to hand over the floor to the management. Thank you, and over to you, sir.
Good evening, everybody. This is Vaidyanathan. Thank you very much for joining us.
Good evening, everyone. I'm Sudhanshu Jain. Thank you for joining.
Hi, this is Saptarshi Gopal. Thanks for joining.
So good evening, everybody. First of all, thank you very much for joining us on this late Saturday evening. You had many results to deal with, so thanks for joining us. The key highlights, I think, for this quarter is that we have come out with guidance 2.0. So when you think of guidance 1.0, which is what we gave at the time of the merger in December 2018, we had guided for, at that point of time, we almost thought that the first year will be gone in just dealing with many matters, so we gave a guidance for 2025. So that while that guidance stays, and we will still keep it on the website and we'll track also to it, you will continue to see it. In the interim, we just saw that this quarter marks exactly the end of 5 exact years after merger. So we've come out with the guidance 2.0. Now, when we started, when we gave the guidance of 1.0, let me just say that we really had very little visibility, very little, because merger just happened, Capital First IDFC just merged, and the deposit book was something like about, retail deposit book was something like about 10,000 crores, and 10,400 crores to be precise. The loan book was something like about 104,000 crores. We had bonds and bonds of about maybe 50 or 55,000 crores. We had wholesale deposits of about 30,000 crores. We had certificate of deposit, just 2 months money, which was about 28,000 crores. So that's sort of an odd base on the deposit side. Deposit borrowing side is largely institutional. We call it 92% institutional. So, frankly, for any management to guess how quickly we will fix this and make it a retail would have been just a good, let me say, good educated guess. Again, on the asset side, a lot of things would have been still in uncertainty. Under those circumstances, we still came out with the guidance. And then after that, we saw COVID, we saw many things. But I'm happy to say that almost literally on every benchmark we are coming good. On one front, probably maybe 1 or 2 elements we are not right up there, but I think we'll get close. So we now, as we gave the guidance, let me just say that during this period of the last 5 years, the key success for the bank has been deposits. Just to share with you that the retail deposits of as of 31st March 2018, 31st December 2018, was precisely 10,400 crores. Today, just 5 years, it is 1,39,431 crores. That is a growth of 1,29,000 crores. If you take the total deposits, we also had 29,000 crores of wholesale deposits with us. So 10,400 plus the wholesale deposit of that 29,000-30,000 crores has made it 40,000 crores or 39,602 crores to be precise. That 39,600 crores is today 1,76,481 crores. So that is again a good growth on deposits. So third is CASA ratio. CASA ratio now has come to about 46.8%, which is again quite strong. So let me just say that one defining factor for the last 5 years has been deposit growth period. And all of us know the deposits practically are the foundation of any bank. And this kind of deposit growth has come despite the fact that along the way, we dropped interest rates. Most people thought that we'd stay with a 6%, 7% strategy for like maybe a long time. But literally within 3 years, we dropped it. And now we pay 0 to 1 lakh, we just pay 3%, just 3. And still last quarter, we saw deposit grow by 44% YOY. 43% YOY. So I think that frankly, once deposit is strong, we are sorted. We are sorted, I say, because the contra side is loan book. Now the loan book, if you see, has not grown very much during this period, over the last 5 years. The loan book has grown from
1 lakh 1,000.
No, that
104.
no, that is 2.2. Yeah. So the loan book during the same period has grown just 1,04,000 crores to 1,89,435 crores, 5 years. So you might say that if the loan deposit grew so fast, 4.5x in 5 years, from 39,000 crores to 1,76,000 crores, then how come loan book only do this much? All of you seasoned investors know the reason, that we slowed down loans just because we wanted to fix the CASA ratio. So basically, the point is that both on the asset side, we have a strong, stable business model. I'm actually happy to share that our NPA now for 14th year running, meaning 14th year means 14, it will become the 14th year in March of 2024. Now 14 years is a really long time. I hope you'll all agree that our gross NPA and net NPA has been 2% and 1%. It's really long time. And in this 14 years, we have broadly migrated from lending to the largely unorganized segment when we started to now we have become relatively more like the more prime bank. Like for example, if we were to give loan against property, say 8 years ago, 10 years ago, we would lend loan against property at maybe 30, 12 or 13% because the banks were doing the prime loan against property of maybe 9.5 then. Today we lend at 9.5 on the loan against property, and then maybe there are other NBFCs who are lending at maybe 13, 14%. So we've come down the risk curve, and therefore we're feeling much more stable about our credit quality going forward. Now the gross NPA at the end of this quarter is just about 1.5% on the retail side, retail, MSME, and rural side 1.45%, and the net NPA is only 0.5%. So it's been a very long time to have sustained, quarter-on-quarter, year-on-year for 14 years. Let me say 13 years and 3 quarters to be more precise. It really gives us a lot of confidence. And anyway, since we come down the risk curve to become a little more like the mainstream bank, I think this should continue now for a while. So therefore, there are 3 things that jump out at our last 4-5 years of work is that the deposit grew, the loan book grew, the asset quality is stable. Now, sorry, somebody is disturbing me on my mobile, so just pardon me. I'm going to just take a small. Yeah. Now, the second thing is that that's one part. Second part is that when we look at our bank, there's a lot of harmony within our bank. Harmony, meaning the way the bank is working, the way the system is working up and down the chain, interdivision. There is a lot of tranquility, and we just focus on our work, and that gives us an ability to move smoothly ahead. And this is all a lot of teamwork going on the bank. Today myself, Sudhanshu, speaking to you as a team, but frankly speaking on behalf of all our employees, that this success actually comes back a while from Dr. Rajiv Lal, because I really don't want to go back and try and say this was the issue or that was the issue, because really someone worked very hard and almost against impossible odds got this bank license. So let me just say the first note of thanks starts with him. It's like an impossible feat. But after that, if he had not got the license, I guess there will be no IDFC Bank today, or IDFC First Bank. And after that, it starts about how the bank has built over the last 5 years, and things have all come good. Now, basis what has happened, how the foundation is built, we are now, and also based on the momentum that we are having, we are now looking forward to how the next 5 years would look like. When you look at next 5 years, frankly, today we have a lot more visibility. I started this conversation by saying we had less visibility when we started, when we gave the guidance 1.2. But now we have far more visibility. We have a stable lending model. We know we are originating about 45,000 crores a year on deposits. And now we are trying to only extrapolate what it would take for us over the next 5 years. So we are now guiding that our deposit base as of December 31, 2023 is 1,76,000 crores as we spoke as the close this quarter. We believe that we will be something like about 5,85,000 crores as of 31st March 2019. Now, if you think that's a very steep climb, just remember that we came from 38,000 crores to here. Now, the other reason why we should feel reasonably confident about this is that currently our deposits are growing upward of 40. For the next 5 years, we've assumed a deposit growing only by 24.8%. We think this should be reasonably easy for us. Next is assets. On the assets front, as you know, we started with 104, today we are 189. Now we are guiding that our assets will be 5 lakh crores in 31st March 2029. So again, don't think it's too steep a jump from 1,89,000 to 5 lakh crore, because we are guiding for only a 20.3% growth 5 years CAGR. We are currently growing 24.5. 20 should be easy, should not be a problem. So a 5 lakh crore loans and advances book, now including SLR, etc., will take us to an assets of about 7 lakh crore. Third thing is, after deposits and the assets, is asset quality. Now, asset quality, today, our gross NPA is only 2.04%. But remember, this has infrastructure. We know infrastructure will go away. We are bringing it down. So, if you see X infrastructure, today our gross NPA is 1.66%. And our net NPA is 0.47%. The way we are trending, we are guiding for a gross NPA of 1.5% and net NPA of 0.4%. That's what we'd like to keep the bank at. Again, considering already 1.66, 1.5 should not be a problem. And considering we're at 0.47, maintaining 0.4 should not be a problem broadly. Give or take economic conditions, another crazy COVID coming, caveating, those kind of weird things happening, they should be achievable the way we're building the business. Fourth is profitability. Now, profitability, now we believe that the bank is comfortably moving towards an ROA of 1.9 to 2%. If you do the maths and you multiply 1.9 or 2% on 7 lakh crore of assets, you can see the 7 lakh was closing number. So the average assets of 28-29 should be something like about 6.3 lakh crore. On 6.3 lakh crore, you apply 2%, you're getting to about 12,500 crore. So we are thinking that our broad guess is that we could be somewhere around 12 to 13,000 crore in profitability in March 2029. For context, for this year, 9 months we are like 2,430 crore. To annualize it, you're getting something like about 3,000 crores. So we believe the 3,000 crores going to 12,500 crores should be very possible. And frankly, if we deliver the first 4 items, you grow the loan book to for 5 lakh crores, grow the deposits to 5,85,000 crores. The rest should fall in line because our business model is pretty straightforward, and if you maintain asset quality. Now, ROE is the last one. We've had a tough time dealing with our cost-income ratios and ROE, etc., because our cost income was always high. We did explain to many of you that because it's set up as a bank, we have branches, this ATM network, technology, all the stuff we told you. But net, it has been it's been part of, we are very clear, it was the setup stage of the bank that we had to do what we had to do to build the bank for the future. So think of it like the first half, or let me say first 5 years has gone into building the foundations of the bank. That process of laying foundation never go away because banks are forever getting built. But we believe phase 2, we will be able to reach the benefit of phase 1. And therefore we are guiding for ROE of somewhere in the zone of 17-18%, give or take. So I would say that these are all in good faith because we have done our spreadsheets and we have analyzed it many times over between Sudhanshu, myself, Saptarishi, etc. But we're still saying this in good faith, results may vary, it can happen, we may have achieved, overachieved, underachieved, whatever, but hardly I'd say more than achieved in guidance 1, may not be achieved in phase 2, so please take all our caveats seriously. But we are being given in good faith with numbers which we believe are reasonably achievable. And frankly, for a bank starting where it was in 2018 December, in 10 years, to reach a position of 5 lakh crore of loan book and 7 lakh crore of deposits, 6 lakh crore of deposits and 12,000, 30,000 crores of PAT with ROA of 1.92, PAT in ROA of 13.18 will be a solid position to be in. And more importantly, the directionally will be looking good. And other things, anyway, apart from these numbers, the bank is a good bank, really high quality bank, good customer practices, good culture, good practices, good, governance, a really very good board, very, high quality board with high quality people. All of them have been through a lot, very sensitive to regulatory commentary and so on, and wanting to work within the guidance of the law and guidance of regulations. So that sort of, compliant bank, I think that we are reasonably well set. So that would be a brief comment to start the discussion. Sure.
Yeah, thanks, Vidya. I'll quickly touch upon certain key numbers. I'll try to keep it short. To start with, the overall balance sheet size now is at 2.7 lakh crores, and balance sheet expanded by 22% on a YOY basis. We continue to see a very strong momentum on our lending book as well as the deposit book. As Vidya mentioned, customer deposits increased by 43% on a YOY basis. It's now 1.76 lakh crores. In fact, the growth in retail deposits was higher at 47% on a YOY basis. CASA ratio also, you would have seen, has improved sequentially to 46.8%. CASA deposits increased by 29% on a YOY basis. Average current accounts have increased by 33% on a YOY basis, and while average CASA increased by 26% on a YOY basis. We also continue to see a faster growth in term deposits, which grew by 59% on a YOY basis, as customers preferred to lock in the interest rates which are prevailing in the system. The growth here also was predominantly driven by retail. Retail deposit ratio to total customer deposits continues to improve and has increased to now 79% vis-a-vis 76% at the start of the year. We have opened about 35 branches during the current quarter, thereby taking the branch count to close to 900 branches. The high-cost legacy borrowings further reduced by about 1,400 odd crores during Q3, and another 1,300 crores is scheduled for runoff in Q4 24. We have given more details around this in the presentation. Moving on to the asset side, overall funded assets grew by 24.5% on a YOY basis to reach 1.8 lakh crores. I will cover this in 4 segments. Retail book comprising a mortgage, vehicle portfolio, that's essentially car and two-wheelers, then consumer loan, credit card, education loan and vehicles. This portion of the book grew at 29% on a YOY basis. We have seen strong growth across all categories. Growth in certain segments like vehicles and consumer were also relatively higher on account of higher demand due to festive season and our increasing presence. Talking of credit card within retail, the bank has now issued more than 2.2 million cards. The book has almost touched rupees 5,000 crores. The gross spends on credit cards increased by 61% in 9 and 24. Further, the SME book, which is for business purposes and the corporate segment, increased by 16% on a YOY basis. Also happy to note a report that infrastructure book is now just nearly 1.6% of the total funded assets and now below rupees 3,000 crores. Moving on to asset quality, the gross NPA of the bank further improved by 7 basis points during the current quarter and stood at 2.04%, and net NPA ratio stood stable at 0.68% during the current quarter. As Vaidya mentioned, if we exclude the infrastructure book, the GNPA improves to 1.66 and net NPA improves to 0.47. GNPA in the retail, rural, and the SME segment also improved by 8 basis points to 1.45%, and the net NPA is now just at 0.51%. The overall standard restructured book continues to come down and has further reduced to 0.35% of funded assets as compared to 0.38% last quarter. More than 93% of the restructured book is secured in nature. Moving on to profitability, profit after tax for 9M FY24 increased to rupees 2232 crores versus rupees 1635 crores in 9M of last year, up by 37%. For the quarter, profit grew by 18% YOY to rupees 716 crores. This was largely driven by strong growth in core operating income. Core operating profit, which is NI plus fees excluding trading gains, for 9M FY24 grew by 35% YOY. For the quarter, it grew by 24% to rupees 1515 crores. For the quarter, NI increased by 30% on a YOY basis to rupees 4287 crores. The net interest margin improved by 10 basis points on a sequential basis to 6.42%. Fee also registered a strong growth. It increased by 32% to rupees 1469 crores for Q3 FY24, and this was largely retail-led, which is at 93% of the total fee. Operating expenses increased by 33% on a YOY basis due to strong business volume witnessed during the quarter. I would say branch expansion and some increase in other expenses like marketing and so on. We had a trading gain of rupees 48 crores during the quarter, and provisions came in at rupees 655 crores for the quarter. The credit cost as a percentage of average funded assets for 9M FY24 stood at 1.26%, which is well below the guidance which we had given earlier. We are not impacted by the guidelines which came recently around AIF investments at all. On an annualized basis, ROA stood at 1.16% as against 1.05% in 9M23, and ROE stood at 10.7% for 9M FY24 as against 9.9% for the same period last year. The bank has maintained strong capital adequacy. The capital adequacy now stands at 16.73% at December 31st, 23, with CET ratio at 13.95%. This takes into account the capital of rupees 3,000 crores which we mobilized in early October. We continue to maintain healthy liquidity levels, and average LCR was at 121% for Q3 FY24. We have been maintaining this on a consistent basis across quarters if you see our previous numbers. With this, so I've covered broadly all the assets, all the numbers, key numbers. We will be happy to take a question.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ishan Agarwal from Erevna Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. I would say decent but slightly underwhelming performance by the bank. So I have 3 questions. Should I ask them together or should I shoot them one by one?
One by one better.
Okay. So the first one being, in our previous times, the management has always highlighted that core total income will go faster than OPEX for 24, 25 and 26, and that is how operating leverage was going to play out. It is slightly disappointing to see OPEX here growing 33% YOY and income growing 31%. which in turn has upped our cost to income from 72.1% last year to 73.3% this year. What is really causing this pain in OpEx? What are the factors playing out, and what the management could not envisage while giving the past numbers?
Let's take them one by one. So thanks for that very quick question. See, this I have always mentioned to you, I don't know, Sudhanshu may have told you again and again, that listen, please don't track us every quarter by quarter. See, we're early stage bank. Sometimes, one odd item expense catches up, some digitization expense catches up on some other product. Something happens one quarter or the other. If you go, YOY, our own guess is if you take all our past cases have come right. I will just point out one number to you. That if you take, a 5-year window, that is 19 to 23, 20, 21, 22, 24 years, you've seen that the balance sheet has grown by 9% from the time of merger to today, 5 years actually, 9%, but PPOP has grown to 43%. So my point, and by the way, I'm not claiming it is still the 943 jaw will be back wide still, but definitely for a balance sheet loan book growing by about 20%, which we added again now, and for the operating profit to increase about 30 to 33%, should be the kind of zone you should look for the next 4-5 years. So, really I told you, it's an early stage bank. Really difficult to point out, this quarter this happened, that happened. It's a waste of your time and waste of our time.
I understand, but this was a YOY increase in cost to income, and that is why I highlighted this. So it's not quarter on quarter which I'm comparing. Even year on year, from 72.1 it is up to 73.3, whereas we're expecting maybe a plateauing or maybe a decline from year on. So
I agree with that. I fully agree with that. I'm just pointing out to you that I'd say this result is a bit underwhelming actually. We should have expected to post a little better. At least at PAT level, we should have posted a bit better.
Core operating, not even PAT, can be some one-off, but that is slightly underwhelming on that part.
I agree. 100% agree. Could have done a bit better, could have expected a little better. But it's, like I said, we're running a long game here for 10-year game. Out of it 5, we finished, maybe even longer from there. Maybe many, many decades after that.
Right.
Just to take this part of this slight movement of one people here.
So going ahead, do you expect that cost to income should start declining from year on, or do we still expect it to keep at this level for a year or two?
Our sense is that Q3, Q4 of 25 should begin to see material movement onwards. We feel that, like I said, there are some movement. For example, some product categories, we are in next quarter onwards, maybe 1 or 2 quarters, there will be some impact because of, we do the digital loans, for example. In the digital loan, for a period of time, there was there was no FLDG permitted, for example. And last quarter, for example, FLDG got permitted. Now we had a certain structure with the counterparty. Now we move on to the structure which is FLDG. When we move to FLDG structure, the benefit of not having credit cost because counterparty will guarantee that FLDG, that benefit will come 2 quarters from then. Meaning when the credit cost would have hit us, they would have supported us, they would have paid for it. But in the interim, the impact would be there. So I don't want to confuse all of you with all this mathematics, but the point is that our own sense is that next quarter we will move over to the FLDG structure. So the benefit of moving to FLDG structure will come in Q3, Q4, 25, and which will show up in credit cost line. So therefore, these movements will slightly give better benefit for us by exit quarter 25.
Okay. So now, as you mentioned about FLDG, my next question was actually regarding credit cost. While our loan book has grown by, say, 24% YOY, our provisions have grown by 45% YOY in spite of all collection efficiency numbers, SMA numbers improving YOY. So what is the reason for this?
Yeah, I said this to you earlier also. Oftentimes when you compare YOY for early stage banks, either last time there would have been something very much remember we were running credit cost of only 1.15%.
So is there any one-off this time, or this is normalized?
Just hear me one second. So we were running really very low credit cost for a book that is giving the kind of yield and NIM it is giving us. Our credit costs are running so low. In fact, many people used to scratch their head here. How can a credit cost be only 1.1%? It is even lower than many, top banks. So, we were, during post-COVID, we were getting certain recoveries. Because if you remember, during COVID, we took provisions. Now, many of the recoveries started coming. So the last 2 years, we were getting the benefit of the recoveries. So some of the recoveries we also taper off. So that's why I said sometimes, there might be some odd jumps here and there. Also, we moved over to the 90th day recognition of NPA rather than 91st day. And that also had some impact. Think of it like here and there. But our guidance is that, let me step back for 2 minutes because, this quarter had a few here and there items. Let me just step back and just give you what we see. And that is the heart of it. What we are seeing is our collection percentage, which we reported at 99.5% now for literally like 2 years at a stretch now. Last month in December, it inched up to 99.6%.
Right.
Let me call it still 99.5% to be sake. So if collection percentage stays the way it is, check amount is very low. Let me say very low meaning very low, which is like 6 point something. So, which also we are collecting during the same month in a big way. So the point is that the underlying parameters are strong, so there's no reason like fundamentally to be disturbed or anything like that. I mean, you watch our next quarter, you see the results for yourself.
Okay. And one more from my end. With the new RBI norms on risk weights for unsecured credit, our Tier 1 capital adequacy is down to less than 14 in spite of the capital raise that we did last quarter, that is in October. So now, given that it is at 13.95%, when do you think we'll again have Tier 1 capital to shore up the capital adequacy?
We will watch the numbers with the way the profits emerge over the next 4 quarters and then make up our mind.
We do have an idea of the capital consumption that the bank will do. So what is your target that, okay, we don't want to go below Tier 1, say 12.5 or 12% or...
No, we don't spell out precisely when you raise capital. It's not a good strategy for any bank to exactly put out in the market. This is capital, I hope you'll agree. So we'll make up our mind as it goes along, depending on the number.
Okay. This is one more. So if I look at the cards data released by RBI, it is unusual to notice that the number of debit cards in force for IDFC in November has reduced for the first time as compared to September, which is so from 67K to 66.5 lakhs. So is there some reason, were there some dormant accounts which were closed or what?
Yeah, so I mean some dormant account cleanup being done by the respective teams. Otherwise, inflow, basically the bank is more and more moving towards quality. And we are like very, very first about it. So we are opening lesser number of accounts than before on the bank accounts, especially on the digital side. But we are focusing on quality. So the inflow is very strong. That's how we saw growth of close to about 4,000 crores a month of deposits that kept coming in. So let me say deposits are rising very well. There would have been some closure of some, customers who are inactive and those kind of respective products keep doing the work.
Okay. Thank you and all the best. It's really commendable the way the bank is growing the deposits. Thank you.
Thank you very much.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. 2 or 3 questions. The first one is around the personal loans. I just want to understand the run rate of personal loans that we originate from various fintechs and the level of FLDG that we do from these fintechs. My fair understanding is that a lot of lending partners do slightly above 5% or maybe above 5%, which is the mandated requirement of FLDG. The second is on the vehicle finance. If we can give out the split of car finance, new car finance and used car finance, and the outlook for the industry as such and our own growth estimates there in FY25. These are my 2 questions. Thanks.
We do work with fintechs broadly, but we have not exactly sat and calculated, put out how much, who's doing how much and all that. But let me say broadly, it's growing. We are very conscious that on the personal loan front, personal loan meaning and basically the unsecured personal loan given. Our model is largely lending to salaried people who want to take personal credit, typically term loans. So in that model, I think things are running pretty well for us. Some originated through partners, some originated by ourselves, some originated through DSS, etc., etc. Second question is about vehicle finance new. I'd say we have more on the used car financing side than the new car side, though we also do new cars. But new cars have no margin, and it's just a waste of time and money. So we give it only to our customers who come to our branches and our base. We lend, we give new cars. With a limited capital, we have to use it for either two-wheeler finance or for used cars. And frankly, credit quality we are building so fantastic. So why waste money on the new cars?
Right. Thank you for that. If I can just squeeze in one last question in terms of fintechs. When we onboard a customer onto our balance sheet, when we are taking the risk, that customer permanently becomes ours. What I mean by that is that once it's onboarded to our balance sheet, it's only we who own the customer in terms of any kind of cross-sell, upsell of credit, non-credit products, or the fintech through which it was originated can also do any kind of cross-sell, upsell as well.
Okay, this is a typical complication that happens in this industry. So typically, digital partners like to also do other things with the same customer. So, for example, we are very clear when we work with them that with anybody for that matter, that our bank is absolutely one condition non-negotiable for us is that we have full rights to access the customer and we will do business with the customer. It's very important to us. It's a fundamental franchise issue. Now, the same party, some party originated with a stockbroking firm which did stockbroking and by the way gave us some personal loan. Well, I'm sure they'll do other things with the same customer as well.
Understood. So the status of the customer is transient and not permanently ours. That's a fair understanding?
That's a fair understanding, yeah. But when we get our salary customers and we lend to them, we feel more in control because it's our customer, 100%. But when it's originated by a party, sometimes party also does something with the customer. Yeah, of course.
Understood. Thank you so much. I'll come back in the queue. Thank you.
And we should be respectful of their income and P&L also. Let us be happy as long as customer is happy.
Understood. Thank you so much. I'll come back in the queue.
Thank you. The next question is from the line of Gao Zichuan from Schonfeld. Please go ahead.
Hey, sir. Thanks so much for the opportunity. So first question is just data keeping. Can I have the growth and the net slippage number this quarter?
Yeah, slippage for the quarter was about 1,400 crores. If you see, it's broadly flattish as in the previous quarter. And even on the net slippage is flattish, right? It's at about 850 crores for the current quarter.
Got it. So last quarter, we talked about there's some timing issues and one of the quarter slippages. So, is there any such issue that is repeating this quarter, or are we expecting, slippage to be gradually trending up from here?
No, so we feel quite comfortable as Vaidya mentioned that we are seeing a consistent asset quality, right? So even in this quarter, the slippages are not gone up while the book is expanded. So we feel that we should be quite okay on this front.
So why does our credit cost is trending up while our, if our slippage number is similar to last quarter, our credit cost should not be trending up, and our coverage ratio is similar to that last quarter. So I just want to understand that.
So if you see that credit cost has been, for this 9 months, has been just 1.26%, right? We had guided the market for 1.5%. Of course, we have been coming to it. This quarter, we have seen a slight jump, right? But that's a combination of your existing book where as the aging happens, some more provisions come in. So as you rightly said, the gross slippage that has been quite stable, right? And other indicators also, like if you see the check bounce, right, which we have presented the data in the presentation, that it continues to be lower, right? First check bounce is about 6.3%. Even the collection efficiency is quite stable, right? Over the quarter, it's 99.6%. So which talks of that the incremental book which is getting built is quite risky, right? We may have, as I said, some of these provisioning impact may come because of aging and so on. So, but we feel quite comfortable with. Yeah, I don't know. I lost you guys at which moment, but the point which I was trying to mention was that gross slippage and net slippage has been quite stable. If you see the asset quality indicators, right, in terms of our check bounce, right, that's down from 9.9% to 6.3%, right, over a period. And similarly, collection efficiency is quite stable for early buckets at 99.6%. So we feel quite sort of confident on the incremental assets which are getting generated. As I said, some of these provisions could come in because of aging. There could be some smaller, lesser recoveries during the quarter. So that is precisely the impact which has come during the current quarter. For the 9 months, if you see the credit cost has been just 1.26%, and which is well below the guidance which we had given earlier. So we feel that things should normalize from here and should continue to stay so. Of course, we are very cautious in terms of sourcing, in terms of credit underwriting, and so on. So we'll continue to exercise prudence on this front.
Got it, sir. And second question is on the guidance. Thanks so much for the clear guidance. Just wondering, if I remember correctly, previously, we were talking about next 4 to 5 years, 25% growth is quite sustainable. So I'm just wondering, our 20% growth kind of guidance now, is it just on a conservative basis? Or, is there some, change in strategy that we maybe focus a little bit more on the profitability side and maybe slow down growth a little bit, or if some RBI related issue?
See, basically, when you look out, probably it's better to be guiding at a number which you feel is reasonably safe and in the bag.
Does that answer your question?
Sure, that's all. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, good evening. So one question. Hi, sir. One question on CD ratio. While bank has been doing well and the CD ratio has been coming down pretty consistently every quarter. And any discussions about this with the RBI given the ongoing reports about this? And any near-term targets therefore that you have?
So if you see that we have been bringing down the CD ratio because deposits have been growing faster, right? Of course, we had legacy problems, right? That's why our CD ratio was 137% at merger, right? If you see even into this year so far, we have brought it down from 109% to 101%, and maybe by the end of the year we will be lower than 100. So we feel that, and even in the guidance, if you see our deposit growth is that faster than the loan growth which we are guiding. So this should keep coming down as we move along.
Okay. And
also, I'm saying, just sorry, one data point is the incremental CD ratio if you see for this year is about 80%, and for this quarter it was just 65%. So as long as the deposits continue to come strong, right, and we feel that we should be able to improve on this ratio. We feel quite confident of bringing it down.
Okay, sure. And the second question is on the OpEx, wherein we are seeing a fair bit of an increase. So if you can provide some color as to what are the key drivers within this number, so that we can better appreciate the operating leverage that is likely to play over the coming years and from Q4 25 that you are indicating.
So Nitin, if you see that, if it is a guidance, because you go to the specifically go to the guidance, for you to really appreciate where this game is headed, I read out the operating leverage numbers at a bank level that we've been seeing year on year. This year, let me say that the operating leverage has not played out that much because, this digitalization expenses and technology, and we are really building the bank for the future. And that has been our consistent strategy, as you know, thus far. So therefore, we feel that from next year onwards, like we said, Q3, Q4 of 25, we should see meaningful movement. And our own estimate is that the OpEx of 25, for example, should just increase by about 20%, where the loan book or the income could rise by, let me say, maybe 24%-25% because of the reason. So we feel that in 25 we should start seeing material opening of the jaw. And again, because see, one thing you should note in the way we are running building out Story 2.0, that the deposit numbers we have kept very modest. The requirement. Imagine just going at 20% or 25. Somebody used to going at 40, 25 is nothing. And remember, what is something unique will play out after 26 onwards, which is 27, 28, 29. I'll tell you what is unique. Today, even when you're growing the loan book at 25 or 24.5, bank is funding this growth of 24.5 from deposits, A, assuming we're not borrowing anymore, but funding it from deposits, plus we are repaying bonds pertaining to the pre-merger. So we are carrying double burden. You fund yourself and also pay your past liabilities. Now, by 1.5 years from now, that lot of it would have gone away. Let me say 2 years. And then after that, you're only funding a loan growth. For somebody who's used to carrying such heavy weight, that should be pretty lightweight actually for us. I mean, relatively lightweight. So that is a material change coming in our life from 26 onwards, let me say 27 onwards to 2030. And we've done the math. There is a big relief in the requirement for deposits then. And actually, who knows, we might even cut deposit rates, and that might be positive for the bank.
Right.
Or we put lesser branches, one of the two. If you
Yeah. And so last question is on the guidance 2.0, where you are giving guidance on three key metrics. But when you look at the ROA of 1.9 to 2 by 29, what levels of margins and cost income ratios are you baking in?
the cost income ratio looking like more like about 55% by the exit year 30. That will be like maybe like 57, 58 or something like that by 29.
Okay, and margins?
Margins, we are assuming similar stuff.
Okay. The earnings is like implying a 30% CAGR.
We request you to please rejoin the question queue for further questions.
Sure, I'm done. Thanks so much.
Thank you.
The next question is from the line of Samir Gite from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just wanted to get a sense on the other portion of the loan book, which is roughly 15,000 crore and growing at a fast rate.
What other?
So this would include digital loans portfolio which we have. We have given in the presentation that it includes digital loans, it includes some portfolio buyout which we have done, and some revolving credit. So that's part of the other book.
And would this portion be secured or unsecured? I mean, in entirety?
Depends on what you're buying, no? But chances are we'll be buying the secured portfolios. To the extent there's buyout. And because to the extent digital loans, it could be unsecured also.
Okay. This is helpful. And secondly, I think in the opening remarks, Mr. Sudhanshu said that there's no impact of the AIF guidelines on the bank. Just wanted to reconfirm.
Yeah, that's correct. We have nil impact on that count.
Okay, great. This is helpful, and congratulations on a good quarter. Strong guidance. Thank you.
Thank you, Sabir.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Thanks for the opportunity. Since on that guidance for FY29, what will be the normalized credit cost that we are assuming there? That's first. And secondly, what will be the losses that we are incurring currently on the credit card portfolio and on the branch liabilities fees right now?
All products are mixed up. When we announce a bank level or a credit cost of about 1 we guide for 1.5, 1.6 actually. We're running more like one point. But so what current numbers include everything. So we've not stretched out the product by product. But let me just say that for the upcoming 5 years, we have assumed a little higher credit cost than what we are currently incurring. Because there is one benefit we have been getting in our credit cost thus far. One is that I mentioned earlier, during COVID, there were charge-offs, and those obviously recovery is happening because you may charge off a loan, but end of the cost you're collecting. So that kind of recovery has been coming to us last 2 years, and we believe that all those benefits will go away. And also, we should be prepared for, just for the sake of it, be prepared for a slightly higher credit cost generally in the ecosystem, nothing to do about us. So we assume a slightly higher numbers than what we currently incur. At least when you're given this guidance, we've padded it up reasonably well, I'd say.
So this essentially means the RO expansion is predominantly driven by improvement in the OpEx.
Yes.
The NIMs is flattish and credit cost would marginally go up from current levels. Okay.
Yeah.
And on the question on credit card portfolio losses that we're incurring right now and the branch expenses?
Because, we're not calling out how much you lost in LAP or this or a used car. We're not giving you product by product. But broadly, we at a bank level, we are in a very, very good control. It's super low. And we, one second. Just put the phone away and please.
Yeah, I was trying to understand the operating losses in the credit card portfolio. Yeah. Like what you disclosed earlier.
No. There was an interruption on my side. My apologies. My mobile phone rang. So I told you when we put out the numbers, we are finding we put a credit cost numbers at the entire retail level and the overall bank level. Because some products we have a good quarter, some products doesn't have a good quarter, some products have more slippage, something has less slippage, something has. But you should look at a composite manner from quarter to quarter, and year to year. And that number is trending very well. Last year a credit cost was 116 basis points. Even in the year of COVID, just think for 2 minutes. I don't want to take you too much back in time. 21-22 was the period of COVID second wave. That is July, August, I think April, May, June of 21. And in that period, moratorium happened. Sorry, it did not happen, but lockdown happened. So obviously Q1 was provision was taken. But for the full year, provision to average book was only 2.51%. Just think, COVID year. So we feel that one of the best things that is happening to our bank is that even in the worst period of COVID, our credit cost average book was frankly among the best among the peers. You would imagine for a book that is yielding a NIM of 6.3, 6.5%, you would imagine 2.5 or maybe 2% even in normal conditions. In COVID, we had only 2.51.
Right.
So and then moment COVID vanished, that is 22-23 came down to 1.17%. 22-23 is 1.17%. This is super low. So we are very confident that we're underwriting good credit. Not confident, numbers are speaking for themselves. So, but we believe it cannot stay this way all the time. So we have not factored for higher numbers.
Got it, sir.
And just to add with respect to your question on credit card, there is definitely economics have been improving there as we are building a more book, right? Cost to income, we have given out numbers that was 164% as of the previous year, and we expect that to come down meaningfully to around 110% for this year. And so we have been guiding that we expect credit card to sort of break even into next year and be profitable in the year to follow. So we feel that it takes some time, right? We have been just 3 years before when we had launched this product. So we feel that we are well on course on this book.
See, one thing we want to tell all of you, and we, just share with all of you, that we have never let you down in credit cost and asset quality for like 14 years now. Anybody who's been with us in capital source years will testify that we never had a credit problem. It's been 5 years, we haven't put 1 foot wrong on credit. Not 1 foot wrong. Every year on year, NPA is good. Year on year, credit cost is low. It's been like 14 years. Now, we obviously, such a long period of time comes from a disciplined underwriting processes, continuous tightening of the norms and revising the norms, continuously staying at the cutting edge of technology, good governance in terms of the number of people who inspect a portfolio. So all these things we have no intention to relax, and we, at least while we have mentally factored for a slightly higher credit cost because we believe we should be generally pessimistic about these things, or cautious about these things, but we have not had a problem, and we'll ensure that we'll try our best to ensure that we don't give you any surprise in this front.
Okay. So just lastly to touch
Sorry to
on one of
interrupt. We request you to please rejoin the question queue for further
Sure.
questions.
Okay.
Thank you.
Thank you.
The next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for that. First, congratulations for the strong deposit growth in such a challenging environment. A commendable job by the management. Sir, from our business model perspective, just wish to understand how much of the collections we do is outsourced.
It's increasingly becoming more and more digital and online, There's a massive shift underway there. So let me say a few years ago, it was largely the whole thing is changing. To give you one very simple idea for you to understand. Earlier, if a customer bounces a check, we'd have a call center call the customer and request the customer to pay, and some agent would go and collect the money from the customer. Now it's not like that. Now you just lot of analytics and technology that happen. Calling itself is not necessarily done by a human being. The call it will probably done by a bot, and the bot will take some promise, and then the bot will send a link to the customer saying that you promised to pay me. Here's the link for you to pay, and customer just pays from the link, and the bank gets the money. So a lot of and these are what I'm sharing with you is a real situation, by the way. So bank is a very digitized bank, and we're able to do such massive progress.
Sure. I specifically want to understand the outsourced collection cost. So if I were to look at the 9-month total other operating expenses, it's around 8,200 crores. Approximately how much would be the cost we pay out of the 8,200 crores to outsourced collection agencies?
Yeah, I don't think we know the number offhand, nor have we put it out. But broadly speaking, directionally, let me tell you that we are becoming the previous answer holds that we're trying to become a more direct-to-consumer bank. But of course, we do have agents. Obviously, customers who don't pay through your digital method, someone has to visit the customer, chase them down, and follow them after PTP after PTP. All that work goes on. And by the way, a lot of our collections in rural areas happens directly by our own employees, not even by agents. Just for information, many locations we don't use agents in rural India. There are many products in which the early bucket collection done by employees themselves, where customers are not. So all that comes to cost of a bank.
Sure. Thank you. All the best.
Thank you. Thank you.
Thank you.
Thank you. The next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Good evening. Thanks for the presentation and the slide on guidance.
Yes.
I have just one question that we earlier had a guidance of 65% cost to income by exit FY25 and 1.4, 1.6% ROA by FY25. Does that still hold both these things, or how should one look at it?
First of all, we'll keep the slides out there so that we don't want to, because we've given guidance 2.0, we don't want to escape from our guidance up to 1.0. So just to share with you that we will be true to that guidance. True to guidance, we'll retain the guidance. God knows how we'll perform against it, but we'll retain the guidance for sure. We'll keep it publicly out for you till the last day. That's our commitment. Now, second part of your question about how we're going to perform against that. The cost income ratio, I think we are a little behind what we set out to do. The good news is, let me tell you one countervailing factor for being behind schedule. Supposing we are at 65 and we turn out to be 68. I'm just making up a number, but I could broadly be right. Let me put it like that. So let me just say that we are behind, to be straightforward with you. Now, how does this play out? What plays out is that income line turns out to be higher than what we guided. Remember, we guided for 5.5. Now we're delivering 6.3. So we're already delivering about 1.3% more on income. So even if your cost income is higher, your ROA may still get there. Are you with me on that mathematics? Right?
Yes, sir.
Therefore, if you notice, the way we look at it is that, composition of book change, model slightly cannot be a little different than what we initially planned, that too, when we get the guidance 1.2, we have only that much visibility, all that. But broadly, give or take, we are in zone. We are going to be in zone of meeting our, deposit numbers. We are into the zone of meeting our loan numbers. Let me say, our asset quality numbers, capital adequacy numbers. We are hitting all the buttons, all the marks. We may not meet let me use a more accurate word. We don't expect to meet exactly the cost income numbers. But because the equation I told you right now, we may still meet the ROA and the lower end of the ROE mark by that time.
Understood, sir. And sir, the ROE mark is, of course, we would be, this of course assumes capital raise at a frequent level as you would still be growing at a much faster pace. So is this ROE is a more normalized kind of an ROE that one should see?
No. You'll be a little surprised about how the game will change. Because what's happening is that we believe that from 25, 26, as it is I told you Q3, Q4 of 25, we do expect a positive momentum cost income ratio, definitely, and improvement in ROE. Okay, let's take that as our sense as of now. When you move forward to 26, now remember we are talking of a loan book of only 20%. We're talking about deposit growth only 25%. So our need for investing OpEx is going to be much lesser than before. The first 5 years we were a complete build-out stage. We had no choice. We were racing against time, back against the wall, huge deposits, a huge amount of big deposits, corporate deposits, certificate deposits, bonds to pay back. It was really tough. It's not going to be that tough now. So our expense requirement will be lesser. So 26 over 25, that will be our expense requirements will be, the expense growth will not be very much. 27 or 26 expense ratio will be even lesser. So basically, and also by the time bonds will be paid back, need for money will be much lesser. So we feel that like I said earlier, the things will get easier for us from that point of view. And life is never easy. God knows what new problems will come. But at least on these front of deposit raising, etc., we feel much more assured now.
Sure. Understood, sir. Thank you so much. And all the best.
Thanks.
Thanks.
Thank you. The next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Yeah. Good evening, and thank you for the opportunity. If I look at your sequential growth in assets or loans, it is one of the slowest in the last 8 or 10 quarters. Anything particular to read into this for the quarter?
No, we want to keep our asset growth, within a zone where our capital adequacy and our credit deposit ratios are all good. So when we have excess, we do IDPC and take them off the books. So some of the numbers we do.
Interestingly, if I look at it, your sequential moderation seems to be driven more by home loans and LAP rather than other products.
That's what I told you. IDPC, sometimes we do IDPC, sometimes we do assignments, meaning direct assignments with other banks also. Basically, we are clear that we don't want to grow the loan book too much even now. So we have taken out some of these loans and done IDPC, interbank participation, with other banks purchase these loans off from us.
Understood. Specifically on personal loans and credit cards, any change of strategy since RBI regulations on risk-weighted assets?
No change in strategy. Fundamentally, they're phenomenal, they're good, they're phenomenal products in the sense that there's a real customer need. Asset quality is good. They're all cash flow analyzed. They are risk adjusted. They make good returns. And they are shareholder value accretive. Fundamentally nothing. But yes, what we have done is we increased interest rates on these products because cost of, equity has gone up.
Okay, sure. Last question from me. The 25 to 20% loan growth over the next 5 years, right?
20%
CAGR. Yeah, 20% CAGR compared to the current growth of 25.
Correct.
Is it likely to be a step function now or a more a glide path in the sense that you grow more in front end and back years as balance sheet becomes bigger, you grow slow? How should one think about it?
Yeah, as when you look 5 years ahead, we can't be sitting and taking judgments on these step function jumps, what happens 5 years from now. So to be more fair and reasonable, what we have done is we have just extrapolated it for 2020, like 5 years. Something like that. So we have not done step up, step down, we have not complicated it.
Got it. Thank you. Those are my
And frankly, in this country, you see even large banks, forget our loan book is hardly anything, 1.8 to 1.9 lakh crore. You see large banks having 10 lakh crore, banks having even 15 lakh, 20 lakh crore. They're all going 20%. Really, 20 is nothing, friend. 20 is nothing. It just happens. And we have to do nothing crazy for that. In fact, growing 25 is good asset quality. Imagine to grow 20, we can in fact trim some of our further cut out the edge customers and further improve asset quality. So 20 is nothing, trust me. We don't feel there's any stress at all growing loan book at 20.
Sure, fair point. Thank you.
Thank you. The next question is from the line of Raghu Garimala from Travis Capital. Please go ahead.
Yeah, my question has been answered. I'm sorry.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to Mr. Jai Mundra for closing comments. Over to you, sir.
Yeah, hi. Sir, just a small clarification. I think it looks a bit confusing, so just for the benefit of all, if you can clarify that, what we have done is we are going at a much faster pace at around 25, and I think that was the more or less understanding given to the participants. And now we have unveiled the new strategy, new guidance, which talks about 20% CAGR. So is this going to be the new normal, or you think because of conservatism, forecasting 5 year out, you have given that 20% range? I mean, that is the clarification I think that is needed.
No, and I appreciate the question. It's a very good question. It's our job to clarify this. See, this thing about 25, the current growth, it's not that tomorrow, next quarter, we're going to come to 20. It won't happen. There's no such plan that, oh my God, you have to apply brakes. There's no such need. But yeah, I mean, if you wake up in FY25 and see the book growth, then you might see that the bank's loan book growth is going only by 20. It's possible because we are planning to slow down the stuff because we feel that the pressure on or maybe it could be 21 or 22, somewhere in that zone. I can't pinpoint to the last decimal, but somewhere in the zone, think about like that 3 years. There is a reason for this. There are two reasons. One is it puts, of course, eases a lot of requirement on the deposit side, and we need to put like branches, we could even cut rates. So, a lot of things happen there. Two is that in an era when everything's looking so fantastic on credit cost front, we do want to warn ourselves again and again here, trim off the edge, the bottom edge. For example, if your score for letting a customer in is, let's make it up, no, I don't mean bureau score, I mean internal score. Suppose there's a score of 750 and there's a cutoff. You might say, let's move 750 to 780 so that the marginal customer goes away. So we might tighten credit or, all that kind of stuff. So the intention is more to slow this down in a way where on a sustainable basis, this can compound for a long period of time. I know you might be a little disappointed 20 after, I don't know if you're disappointed or not. You may be, I don't blame you for that. But trust me, even at 20 for compounded for a long period of time, especially when the operating leverage will open out from there, and our OpEx requirement will be lesser, it may actually be a good strategy, a more sustainable strategy, and like that. For now, we have assumed this strategy. We could do slightly higher, God knows, maybe slightly lower, but think of us in that range as the intention at this point of time. Does that answer the question?
That answers very well. So that is all, sir. If you want to have any closing comments.
Then a closing comment, really, I wanted from you only. You can be honest with me. Are you disappointed about the 20, or are you okay with it? What would you think would be the feel of the house?
No, sir, it is not about this being happy or disappointing. As you said, you are clearly right that if you want to, let's say, if this helps you in maybe more better filtering of the marginal customer, that is one. And of course, it will ease off some pressure on the deposit. It looks like, sir, at the system level, it looks like that to be the, let's say, a narrative built up that suggests that, RBI or at system level, there are, the system level, the growth needs to be calibrated a little bit. So I think that is in that direction, but nonetheless, sir.
You could say that. To be honest, you could say that also, because there is a message from the regulator also to curb exuberance. You could hear public comments on this and exuberance does build up in good times. So we do think seriously about that. So this is a time to trim the marginal customers, and the slowing down from 25 to 20 also helps in that process. So it is a more stable story. I hope, even if you're disappointed, hopefully you'll become a convert after some time of our line of thinking.
Sure, sir. Yeah, that is all from our side, participants. Thank you so much for joining. And thank you, management, for giving us the opportunity to host the call.
Thank you.
Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.